Alrighty. So in today's video, I'm going to be talking about one of the most requested topic for me to create a video on, and that is how to generate a weekly income using covered calls. So ever since I created the video called the upgraded covered call strategy, I had a number of people reach out to me to request for this topic, and a few of them actually asked me to analyze Tesla for this strategy. So that's what I'm going to do for the rest of this video. I'm just going to use Tesla as an example, but of course you can use this strategy on other stocks as well. So first off, the idea is to just keep selling this cover call pretty much every week. So what you're looking at is around 7 DTEs, or 7 days to expiration. Now, of course, this is the ideal scenario that we want, to keep selling this cover call every single week, let it expire out of the money, we collect the premiums, and we can keep doing this for maybe even a year. However, in reality, as you know, it's not going to be that simple, because if the stock actually shoots all the way past up your cover call, then there's always a chance to get caught away. So when you're doing this strategy, especially if you're planning to sell this on a weekly basis, then you need to be actually okay if your stocks get caught away. So this is one of the important things that you need to understand if you plan to sell the weekly covered call options, because you can't say that I want to generate income every week, but I still want to hold on to my shares. Now, of course, as much as possible, we want to try and do that, but there'll be times, like I mentioned, the stock is going to shoot all the way above your covered call, and this is where it's going to be a little bit difficult for you to not get assigned, because your cover call is going to be pretty much deep in the money. But there are certain things that you can do to try and reduce the chances of assignment, and I'll get into that in a little bit. But first off, I want to talk about where you actually sell the covered call, because one of the things that I notice quite a number of people do, especially when they're beginners, is that they just keep selling the covered call regardless of where the stock is. And this is one of the things that can be considered a little bit dangerous if you are actually selling the cover call below your entry price. So let's say, for example, all right, let's just say that you have 100 shares of Tesla at this price down here, and the very first cover call, you sold it somewhere around 360. Okay, so let's just say in 7 days time, the stock actually goes down. This will actually expire. All right, so you no longer have this cover call, and you already collected the premiums for the cover call. So now you want to put on the new cover call. Now at this point of time, let's say you go to the option chain and you take a look at the strike price. You notice that the furthest that you can reasonably get for a decent amount of credit would be somewhere, let's say around $260. Let's just say it's going to be somewhere around here. So that means the price of Tesla probably have gone, pretty far down. So let me just imagine that, maybe the stock has gone to about this price down here. All right. So as an example only. Now, at this point of time, if you were to sell the cover call that is below your entry price, then this can give you a little bit of a problem if Tesla all of a sudden shoots back up, right? Maybe there's a gap up, or maybe there's some positive earning news and the market all the way shoots up above your cover call. Then this is where you're going to have a situation where you're potentially going to be called away at a price that is below where you have the 100 shares. And if this happens, this is where you're actually going to lose money on this position, because you have 100 shares at this price, but you're being called away at this price. That means to say that you have actually closed this position at a loss. And the loss is pretty much the difference over here, minus off the premiums that you collected. So the first thing is that if you want to do this strategy, sell it weekly, you at least want to sell the cover calls either at the entry price of your 100 shares or above. So this way you at least eliminate the chances of you being called away at a price that is below your entry price. Now, the next thing I want to talk about is selection of the strike price. So for this, let's head on over to the option chain. Okay, so the first thing we want to look at is somewhere around 7 DTEs. But as you can see over here, we really do not have the 7 DTEs, and the choices that we have surrounding 7 DTEs is pretty much this too. So it's just 3 days to expiration and 10 days to expiration. And in this situation, I would suggest to go for the 10 DTE rather than the 3 DTE, because although you can sell the 3 DTE and then sell the next one 3 days later, which is going to be this is going to be 7 DTE for more income. One thing you need to understand as well is that when you go for this very short-term DTEs, you generally won't be able to get a strike price that is pretty distant away from where the current market price is. So for example, if I was to go over to the 3 DTEs over here, and let's just say we want to target 10 deltas. So when we are selling the covered calls, if you do not want to have a high chance of getting your shares called away and having your covered calls being in the money, then you want to go for somewhere around 10 to 15 deltas. I would say this is somewhere pretty distant away from where the current market price is. At the same time, you have pretty decent premium as well. Now, one thing I would avoid is to go too far out of the money, because by then you can see that you don't actually have too much credit for you to receive over here. Okay, so I would say somewhere around the 10 to 15 deltas. So if I was to see the 10 delta in this example, you can see that the strike price actually is giving 352.5. So the current price right now of Tesla as of this recording is around $308. So when you sell the 10 delta based on 3 DTEs, it's going to give you around 352, which is roughly about $45 or so away. Now let us take a look at the 10 DTE at the same delta and see what is the strike price that we can get. So let us go over to the 10 delta as well. So let's go all the way down here. So you can see over here, this is the 10 delta, and immediately you can see that the strike price is 370. So this is about maybe close to $20 difference. So just for 7 days out, you notice that you can get about 20 points away. So why is this important? This is important because in the event that Tesla really all of a sudden shoots up and way above your covered call, let's say even above 370, then in this situation, at least when you're called away, you have a bigger capital gains, because remember, when you're called away, you're also profiting not just on the covered call that you sold, but also on the underlying. So if you had, let's say, entered the Tesla 100 shares at around 308, then 370 is going to be close to about $6,000 in profit. So this is going to be an additional $2,000 on top of the 350 strike price which we would have gotten in the 3 DTEs. So out of these two, in terms of closest to the weekly DTEs, I would say it would be this one down here, right? So 10 DTE. Now, one thing you'll notice is that as we go down this ladder, the price is actually getting higher. Now, I understand that this actually confuses quite a number of people, especially if you're new to trading options. Then there's one thing that you can do to actually help resolve this confusion, and that is to click on this one down here. So this can only be done on Tasty Trade from what I know. So if you have a Tasty Trade account, you can just simply click this one down here, and you can see that as the ladder goes up, so does the price as well. So now it's so much easier for you to see, where to look out for in terms of the delta. So you can see that the 10 delta down here is at 370, so you know that it's going to be pretty much above where the current market price is, which is somewhere over here. So this is a pretty natural way for you to look at the option chain, I would say, because it's pretty much how you will look at the chart as well. Now, the next thing that you might probably be interested to know would be how much can you actually make from selling this weekly covered calls. So for this, you can actually have a rough idea if you were to go to the backtesting tool on the Tasty Trade platform. So as you can see over here, this is the backtesting tool. So just from this tool alone, we can actually have a rough idea as to how many times our covered calls actually expire out of the money, and we can actually keep the premium, and also overall, how much do we actually make at least over the past 12 months based on the data which we have here, and also how many times do we actually get assigned. That means to say the stock actually go above the cover call and have your stock get called away. So you can actually have an idea just by using this backtesting tool. Now, one of the limitations of this backtesting tool is that you cannot actually simulate a cover call position over here. So the next best thing that you can do is actually to just sell a call option and just take a look at the call by itself without the 100 shares. So this by itself is just called a naked call, and it's going to be a very bad strategy if you were to sell this by itself, right? So definitely not recommended. You definitely want to do this with a 100 shares to turn it into a covered call, or maybe even with a long call option to turn this into a poor man's covered call. But I'm just going to use this short call option down here just to let us have an idea as to what kind of amount or income we can generate on Tesla. So as you can see over here, I put it as one contract. For the strike, we're just going to put it as 10 delta, and for the expiration, we're going to change it to 7 DTE. And then we're just going to limit it to just one active trade, and everything else we just leave it unchecked. So basically what it does is that every 7 DTE, once it closes, it will just put on a new one, pretty much like how the idea to sell a weekly covered call is like. So we're going to hit the run back test and take a look at the results. Okay, so the results are out, and first thing you'll see is that we are in a loss, but this is of course the naked call. So that is why I say do not do the naked call, because it is going to be a very risky, dangerous strategy where your loss is actually unlimited, because the stock can just keep going up, and if it does, then this is where you're going to lose a lot of money. So no naked call. All right, so the thing that we want to look at really is not this, right? This over here does not actually give us any information regarding our covered call position. Instead, we are going to head on over to details and logs over here. So if you go to details, over here, you can have an idea as to how many times your covered calls actually expired out of the money and how many times it actually got assigned. That means it actually gone above your covered call and have your stock get called away. So if we were to sell the 10 delta, based on the last 12 months, you can see that the win rate is about 84%. That means to say about 84% of the time, your 10 delta cover call is going to expire worthless, and that's where you generate the income. But the other times, as you can see over here, I think roughly total of about 1, 2, 3, 4, 5 times, you're going to get assigned. All right, so I'm going to touch on this a little bit later on as to what we're going to do if, let's say, the stock really goes past your cover call. So, but for now, let us take a look at the income side. By the way, if you like this video so far, please subscribe and also click the thumbs up button. And also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So for this, we are also going to take a look at the logs over here. So I'm going to hit the logs. And this is where you can actually see the premium that you have received for selling the weekly covered call, right? As you can see over here, this is the premium that you have gotten. And of course, down here, the loss would have greatly exceeded the income that you generated for the covered call. But if this is going to be a covered call position, then of course, this is actually going to be good news for you, because you are also going to be profiting on your shares. All right. So of course, first thing that we want to assume is that you can keep selling all of this above where your entry price is. Now, of course, this is not going to be realistic, because there will be times where the stock is going to be way below your entry price and you're not able to sell the covered call. All right. So this assumption down here is just assuming that you can just keep selling the weekly covered calls above your entry price. So how do we know exactly how much is the income? Well, all we got to do is just click this download trades over here, and then you just put it out in a spreadsheet, and then you just remove all this and you just tabulate all the profit. In fact, that is what I've done. So over here, as you can see, this is the spreadsheet that has been generated by the backtesting tool. And what I've done is that I pretty much just deleted all the losses down here, because what it just means is that this is where you're going to get assigned. So you can see over here, you generate roughly about $4,000 over in just about 12 months. And I would say you would definitely want to discount this by a bit, because like I mentioned, not all the time you're going to be able to sell the covered call above your entry price. There'll be times where the stocks drop, and that's where it's going to be difficult for you to sell the covered call that's above your entry price. So I would say maybe you divide this by 2. So maybe 50% of the time you're able to sell the covered call above your entry price. So this is based off of 10 delta. I've also done it for the 15 delta, as you can see over here. And based off the 15 delta, you can have slightly more. So whether you choose 10 or 15 delta, this is really a personal preference. And it's just pretty much a trade-off, right? So for the 15 delta, although you receive much more overall premiums, you actually get assigned much more often as well. That means your share is going to get called away more often. As you can see over here, for the 15 delta, you're going to be called away about 1, 2, 3, 4, 5, 6, 7, 8, 9 times, whereas compared to the 10 delta, it's going to be 1, 2, 3, 4, 5, 6, 7. So 2 more times with the 15 delta. So either one, it's fine. This is really up to you to decide. Now, the next thing I want to talk about is to diversify your long stock positions as well. Because if you were to sell cover calls on all your positions, then you can see that after selling the first 2, then you're going to get called away already. And sometimes it can be a little bit difficult psychologically for you to re-enter into the stock again. So that is why a lot of people would prefer to not have their shares called away. Now, remember, first thing, like I mentioned, if you do the cover call strategy, you have to be okay with being called away, because this is part and parcel of the strategy. If you do not want to be called away, then you just simply do not sell the cover call at all. Now, what if you still want to generate some income from the cover calls, but also have a way for you to not get called away at all as well? Then the next best thing is to actually diversify what you do with your long share positions. So this can only be done if you have more than 100 shares of the stock that you own. So let's just say, for example, you have 200 shares, then guess what? There's no need for you to sell cover calls on the full 200 shares. What you can do is, for the first 100 shares, you can keep doing this weekly cover call strategy to keep getting the income. And for the second 100 shares, just do not do anything with it. Just hold on to it. So this way, in the event if the stock shoots all the way up past your cover call, then at least you still have this one where you're not being called away and you still participate in the capital gains, or at least for you to hold it for the long term if the stock really just keeps going up. And let's say in the event whereby the stock pretty much went sideways or maybe go down a little bit, then at least you have this one down here where you have already sold the cover call for you to generate some income on it. All right, so if you want to have a way for you to suit your psychology a little bit, whereby you want to get an income but also you do not want to get caught away, then do this method. This way, at least you can have kind of like the best of both worlds. Okay, so the next thing that I want to talk about is, what if you sell the weekly cover calls and then the stock go all the way up past your cover call? What do you do at this point of time? Well, there are pretty much two things that you can do. The very first thing is very simple. Just let it get called away, right? You let it get called away and then wait for an opportune time again, and then re-enter the shares either by buying the 100 shares outright, or you can get into the wheel strategy for you to get into those 100 shares. Either one is fine. Now, the second method is for you to roll the cover call. And the time for you to roll the cover call is the moment the stock actually touches the strike price of the cover call. You do not actually want to wait for the price to go past your cover call before you roll it. Because when you're doing the weekly cover call, the time left is not going to be a lot. So if you sell, let's say, the 7 DTE, and let's say by the time 5 days has passed before the stock actually went past your cover call, then it's possible that your cover call actually get assigned and your shares going to get called away. So if you really want to reduce the chance of your shares actually being called away, then you want to start rolling the moment the stock actually touches your cover call. So how you want to do it is like this. So let's just say we sold the 7 DTE cover call, and 4 days have passed and the stock has gone up and it has touched our cover call strike price. So let us simulate this. So that means now there's roughly about 3 DTEs left, and our call option is somewhere around at the money at this point of time. So on the left hand side is where the calls is. So we're going to look at, let's use 307.5, because at this point of time, this is where your cover call is going to be slightly in the money, because right now Tesla is $308 as of this recording, and 307.5 is basically below that. So right now your cover call is slightly in the money, and this is where we have a situation where we need to do something with this. Otherwise, it's going to be assigned and your shares is going to be called away. So how do you actually roll this cover call down here? So the whole idea is to roll out to a further DTE and up to a higher strike price. So how do you want to do that? So first of all, we need to simulate that this is a short strike right now. So I'm just going to remove this, because if you just put it as a short, then we're not able to do the rolling. So as you know, the rolling is going to be buying back the strike price and then selling a further away DTE. All right, so what we're going to do is we're going to buy this, and we need to keep in mind that at this point of time it's $10.65. So when we are selling the next cover call, it has to be above $10.65 for us to have a credit when we are rolling this cover call. So I'm going to find a further DTE. So where are we going to go to? So we have a number of choices, but if you want to keep things around 7 DTE, then obviously the next one we're going to look at is around 10 DTE. So we're going to take a look at the 10 DTE over here. And we are going to see how far we can go for $10.65. So we need to get above $10.65 in order for us to get a net credit. So I'm going to go down here, and as you can see over here, there are a few choices that we can go for. So we can definitely go for this one, because if you were to buy the 307.5 and you sell the 310, so first thing is going to be out of the money, which is going to be above this, and we're going to receive a net credit of $2.72. So on top of getting a further strike price, we are also going to have a net credit. However, what you need to also realize is that 310 is not too far away from where the current market price is, because if the stock just goes up again by another $2 or so, this is going to be in the money again, and then you're going to have the same problem again. So what I would actually do is I would try and roll it to as far as a strike price as I can get. So in this case, we can actually go for 317.5 because we're going to be in a net debit. Okay, so in this situation, I will just go for this 315 because it's going to be a net credit. So over here, you've actually rolled to around 315, which is about close to, I would say, $7 above where the current market price is. So you have some room for the stock to actually move again. Now, if you are not too comfortable with 315 because it's not too far away, as you can see, it's around 51 delta, then this is where you have no choice, but you have to go to a further DTE. Because when you go to a further DTE, this is where you can actually get a higher strike price. So let's say, for example, if I go to the 23 DTEs and I try and find the strike price, which can give me roughly about $10.65 in credit and more, it will be this. So you can see over here, if I go for this 335, I'm going to get roughly about 52 cents in the net credit, and it's going to be much further away. As you can see, it's 335, and we have pushed it to about 38 deltas. So at this point of time, you do have a decision to make. Do you want to go for the one where it's it's shorter in terms of DTE, but you're going to have a much closer strike price, and it's going to be much easier for the stock to actually go above that strike price? Right, so I think we went for somewhere around here. I think it's 315. Or do you want to go for the one that's further in DTE, but you actually have a further away strike price, so that in the event where the stock really shoots up, you're going to get more in terms of the capital gain? So there's no right or wrong here. It really, in the end, comes down to your own preference. So you might be asking at this point, Davis, what if by the time I put on this covered call again and the stock goes up again, and this time it goes up maybe 3 days into when I rolled it? So at this point of time, maybe 3 days have passed. This now becomes 20 DTE, and this is way above the 7 DTE, which I originally had intended for this strategy. And this is one of the things that can happen, especially if the stock just keeps going up. And at a certain point in time, you just have to be okay with the fact that you're probably going to get assigned and have your shares caught away. Right? So the only thing that you can do at this point of time, of course, is to just roll it again. And you can actually roll it even further away to a further DTE, but it will just keep increasing in DTE until to the point where it almost becomes ridiculous for you to just have the cover call on. Because imagine if you rolled all the way to 101 DTE, then you have to wait 101 days for the cover call to eventually expire or get assigned, right? So in this situation, you definitely do not want to roll to this. So I would say the furthest you probably want to roll to would be around 45 DTE. And at that point of time, if it's still going to be in the money, then you just have to resign to the fact that you're probably going to get called away, or you just wait until expiration and see whether the stock is going to go below the cover call. And then once it expires worthless, you can sell the 7 DTE all over again. Okay, so this is the weekly income cover call strategy. I hope this video has been helpful for you, and if it has, I would greatly appreciate if you give me a thumbs up on this video, and also subscribe to my channel for more options trading videos like this, and I will see you in the next one.